Today, we'll be doing dividend decision. And this is the fourth part of financial management. Now, what are the learning objectives? First, we need to understand the concept of dividend decision and then the factors affecting it. Now, what is dividend? Dividend is that part of the profit which is distributed amongst the shareholders. Now, how does a company decide whether to pay dividend or not? That means, how does the finance manager decide how much to give as dividend and how much to keep back as retained earnings? So there are certain factors that he considers before deciding how much to be given as dividend. And we'll be doing that in this video. Now, dividend decision has got two parts. First, how much to distribute as dividend, that is to the shareholders, and how much to be kept back as retained earnings. Now, what he keeps back in the business as retained earnings is going to increase the earning capacity in the future. Therefore, we say that retained earnings also influence the financing decision of the firm, because financing decision is where the funds are going to come from in the long run. So that part of the funds which are available within the business is called retained earnings. So retained earnings influence the financing decision. Now let's come to the second part that we had said, the factors affecting the dividend decision. First factor is the amount of earnings. If the earnings are more, definitely the dividend that will be declared will be more. And if the earnings are less, the dividend will also be less. Let us say a company makes a profit of 100 crores. So out of 100 crores, the finance manager will declare dividend. But if the company has made a profit of only 50 crores, then the dividend will be declared out of 50 crores. Second point is stability of earnings. If the earnings are stable, means over a period of time he is having almost the same amount of earnings, then he will be in a position to declare more dividend. But if the earnings are not stable, sometimes it's more, sometimes it's less, then a prudent finance manager will not declare much dividend, because the year when you have more earnings, you can declare dividend. But what happens when the earnings are less? So if the earnings are less or not stable, then the finance manager will declare less dividend. Then the third factor that he has to keep in mind are the growth opportunities. If there are growth opportunities, then the finance manager will keep that profit that is earned as retained earnings, because he would like to use it to invest somewhere. So he will declare less dividend. But suppose there are no growth opportunities, there's recession in the market, then in that case, the finance manager will declare more dividend. The fourth point is the stability of dividend. So every finance manager wants to give stable dividend. So per share dividend, either percentage or rupees, he keeps fixed. For example, rupees 20 per share dividend he declares. So he will keep on declaring 20 rupees per share year after year. He will increase it only if he feels that the earning capacity of the company has actually increased. If the earnings have increased only for 1 or 2 years, he will never increase the per rate share of dividend. So if he feels that the earning capacity has gone up, then maybe he'll start giving 25 rupees per share as dividend. Then comes the cash flow position. Now, dividend, as you know, is given in cash. Your parents might be holding shares and securities of different companies, and they might be getting the dividend in their bank. So if and only if the company has enough cash, then only they will declare more dividend. Now remember, cash and profit are two different things. They're not the same. So if the cash flow position is strong, then the seventh point is taxation policy. Now, there's tax on dividend. So if the tax on dividend is high, then the finance manager will declare less dividend. Let us say the finance manager has announced rupees 20 per share and the tax is 50%. So the shareholders will get only rupees 10. If the tax on dividend is less, then he'll declare more dividend, because then the shareholders will get more money, and the tax rate keeps on changing. So this is also a criteria that the finance manager has to keep in mind before he decides whether he should declare dividend or he should keep it back in the business as retained earnings. Then the eighth point is stock market. So all the securities of various companies are listed in the stock exchange. So how much is the amount of dividend that is declared by a company that affects the price of shares? So the finance manager also keeps an eye on how the dividend that he declares is going to affect the price of the shares. So if the stock market reaction, he wants the reaction to be positive, then he will declare more dividend, because more the dividend, more will be the interest the people will show in your shares. And if he's neutral, suppose the price of the shares are already high or the company is already doing too well, then he's not bothered as to whether he declares dividend, how it's going to affect the price. Then in that case, he may declare less dividend. Then come to the access to the capital market. Access to the capital market means, does the finance manager have any access to the market from where he can raise funds? Capital market is a market from where the finance manager can raise funds in the future. It is for the long term. It's funds for the long term. So if he has access, that means he can issue his shares and people are buying his shares. If he has access to the capital market, then he doesn't need to keep retained earnings, because retained earnings are also a source of long-term finance, internal source of long-term finance. So if he has access to the capital market, then he'll declare more dividend. But suppose he doesn't have any access. Small businessmen, they don't have access to the capital market. So they have to arrange for their own source of funds. So as a result, if the business doesn't have any access to the capital market, then in that case, the finance manager will declare less dividend. Then come to legal constraints. Now, declaring dividend, there are certain provisions given in the Companies Act, which keeps on changing. So the finance manager has to keep in mind, what does the Companies Act say about declaring dividend? Dividend is tax-free in the hands of the shareholder. So therefore, there are certain restrictions by the Companies Act itself regarding the amount of dividend that can be declared. So keeping all that in mind, he will decide how much of dividend is to be declared. Then the final point is contractual constraints. So sometimes the business might have taken loan from the bank. So the bank always puts certain constraints on how dividend is to be declared. Because today your company is making a huge amount of profit and you are able to pay a huge amount of dividend. What about tomorrow? Suppose you are not able to make that much of profit, then how will you return the loan and the interest that the bank has given you? So to safeguard their own interest, they will not allow you to declare dividend beyond a certain limit. So these are the restrictions put by the lender. So the finance manager keeps that in mind to see what are the restrictions, and according to that only he declares dividend. So these are the factors that the finance manager keeps in mind while he's declaring the dividend. Now, after studying all the factors, now let us see the case study. And first, before we start with the case study, we will read the question that has been asked so that we know exactly what we are looking for. And here it says, quoting the lines from the above discussion, identify and explain any 4 factors. There may be more than 4 factors, but we are supposed to identify any 4 factors. So Abhishek Limited is manufacturing cotton clothes. It has been consistently earning good profits for many years. This year too, it has been able to generate enough profits. There's availability of enough cash in the company and good prospects of growth in future. It has many shareholders who prefer to receive a regular income from the investments. It has taken a loan from ICICI Bank and is bound by certain restrictions on the payment of dividend according to the terms of the loan agreement. The above discussion about the company leads to various factors which decide how much of the profits should be retained and how much has to be distributed by the company. Now you have to identify any 4 factors which help the finance manager in taking the dividend decision. So let's see it, check it out. I'll give you a moment, then I'll share the answer with you. Yes, you must have got it. So let's see. They're earning good profit, that is the first point. Then availability of enough cash, that is cash flow. Then many shareholders who prefer to receive regular income, that means shareholders' preference. And they've taken a loan from ICICI, that means contractual constraints. So let us check out. Yes, now they've told us to quote the lines also. So it has been consistently earning profit, means stability of earnings. There's availability of enough cash in the company, that is cash flow. Good prospects of growth, growth prospect. It has many shareholders, means shareholders' preference. And it has taken a loan from the bank, that is contractual constraints. So this is how the case studies should be solved. Thank you.